In 2013, people in Cyprus went to bed with money sitting in their bank accounts. Normal people, business owners, families, people who had done everything right, earned their money, deposited it into a licensed bank, trusted the system. They woke up and nearly half of it was legally gone. Not stolen, not hacked, seized. Taken by the government in a coordinated action to prevent the total collapse of the Cypriot banking system. The operation had a name. They called it a bail-in. And when it happened, most people in Cyprus, and most people watching from the rest of the world, had never heard that term before in their lives. Here is what I need you to understand before we go any further. The United States of America has a bail-in law. It has been sitting on the books since 2010. It was passed by Congress, signed by the President, implemented by the Federal Reserve and the FDIC, and it is fully operational right now today. It is called the Orderly Liquidation Authority. And as of the end of the fourth quarter of 2025, there is approximately $9 trillion in American bank deposits that this law could legally apply to in the event of a significant bank failure. $9 trillion held by businesses, held by municipalities, held by payroll accounts processing employee paychecks every 2 weeks, held by commercial real estate operations, held by high net worth individuals who believe with complete sincerity that they are depositing their money into a safe, federally protected institution. But under the written law of the United States, every single dollar of that $9 trillion above the $250,000 per depositor FDIC limit is not classified as a protected deposit. It is classified as an unsecured liability of the financial institution. In plain language, those depositors are not account holders with federal guarantees. They are creditors of the bank, and in a structured resolution, creditors absorb losses. The deposit insurance fund that exists to back the system, the actual reserve sitting at the FDIC, stands today at $153.9 billion. $153.9 billion in real protection against approximately $9 trillion in uninsured exposure. Work that math and you get 1 cent of insurance coverage for every 60 cents of risk. That is the architecture of the American banking system as it exists on April 28, 2026. Not as a conspiracy theory, not as an alarmist interpretation, as a published federal law, documented in FDIC quarterly reports, confirmed by the Federal Reserve Bank of St. Louis in its April 2026 banking analytics release, and available to every single depositor in this country who chooses to read it. My name is on this channel as Recession Warnings, and what I do is read the documents that most people never look at, and translate what they actually say into language that anyone with money in a bank account needs to understand. And today I want to build for you the precise legal and financial architecture of the bail-in framework, what the law says, where the gaps are, what happened in the real-world cases where this framework was activated, and what the specific convergence of stressors on this particular date in April 2026 means for your deposits, your business accounts, your payroll operations, and your financial decision-making going forward. Because the gap between what most American depositors believe about the safety of their bank accounts and what federal law actually provides is wider today than at any point since the savings and loan crisis of the 1980s. And on a day when the Federal Open Market Committee is meeting, when the Bank of Japan is signaling a rate hike, when Brent crude is trading above $100, when the Strait of Hormuz is functionally closed, and when Microsoft, Alphabet, Meta, and Amazon are all reporting earnings in the same window as the Fed statement, this is not an abstract legal discussion. This is a live risk conversation. Let's start with the legal foundation because you cannot protect yourself from a framework you don't understand. The Federal Deposit Insurance Corporation was created in 1933 in direct response to the bank-run catastrophe of the Great Depression, when approximately 1/3 of American banks failed and millions of depositors lost everything they had saved. The core promise of the FDIC was straightforward. Deposit your money in a federally insured bank, and your deposits up to the insured limit are guaranteed by the full faith and credit of the United States government. That framework has worked. It has survived thousands of bank failures. It is legitimate, well-tested, and when it applies, it works exactly as promised. When Metropolitan Capital Bank and Trust failed on January 31, 2026, insured depositors were protected. The FDIC absorbed a $19.7 million loss from the Deposit Insurance Fund. The system functioned as designed. But in 2010, Congress created a second framework alongside the traditional FDIC process. Title II of the Dodd-Frank Wall Street Reform and Consumer Protection Act established the Orderly Liquidation Authority. And the OLA is an entirely different animal. It was designed specifically for the largest, most interconnected financial institutions, the ones whose failure could cascade through the entire financial system and potentially bring down markets, freeze credit, and trigger a depression-level economic event. Under the OLA, when the FDIC, the Federal Reserve Board, and the Treasury Secretary collectively determine that a systemically important financial company is failing and that its failure poses a systemic risk to financial stability, the FDIC can be appointed as receiver and execute a resolution process that is fundamentally different from the traditional receivership. The key difference is this. Instead of the government absorbing losses, the losses are imposed on the institution's shareholders and creditors in a structured hierarchy. This structured imposition of losses on creditors to rescue a failing institution, is the bail-in. Here is how the hierarchy works, and this is the part that every depositor above the $250,000 FDIC limit needs to understand precisely. First in line to absorb losses are shareholders. Their equity is wiped out completely. Second are junior unsecured creditors, subordinated bondholders, junior debt holders. Third are senior unsecured creditors. And this is the category that matters for the $9 trillion. Under the OLA framework, uninsured depositors, meaning depositors holding balances above the $250,000 FDIC limit, are classified as general unsecured creditors. They sit in that third tier. They are subordinate to secured creditors. They are subordinate to the administrative costs of running the resolution itself. They may receive priority above certain classes of bondholders in some scenarios, but they are explicitly and legally subject to potential loss if the bank's remaining assets are not sufficient to pay all liabilities. The law includes a protection called the least cost test, the principle that no creditor should receive less in a resolution than they would have received in a straight liquidation. But here's the critical fact that test obscures. A straight liquidation in which the bank's assets are worth less than its liabilities produces losses for unsecured creditors regardless. The least cost test does not protect you from loss. It only protects you from receiving less than the worst case scenario. And the worst case scenario for an insolvent bank already includes significant depositor losses. Now here is where the architecture gets more complicated and more dangerous than most people realize. The OLA framework was built around a concept called single point of entry resolution. Under SPOE, the FDIC takes receivership of the top-level holding company of the failing institution, not the operating bank subsidiaries. It then converts certain liabilities of the holding company into equity to recapitalize the structure, and allows the operating subsidiaries, including the commercial banking subsidiary, to continue functioning through the resolution. The theory is elegant. The bank keeps operating, customers don't panic, markets don't freeze, and losses are absorbed by the holding company's creditors rather than by the general public or the deposit insurance fund. On paper, the framework is sophisticated and the logic is sound. In practice, the FDIC's own internal watchdog has documented serious concerns about whether the agency is actually prepared to execute it. In September of 2023, the FDIC's Office of Inspector General released an evaluation of the Orderly Liquidation Authority program. The findings were not encouraging. The OIG found that the FDIC had not maintained consistent focus on developing the OLA program in the more than 12 years since Dodd-Frank was enacted. Specifically, the FDIC had not completed operational level policies and procedures for executing an OLA resolution. It had not fully defined individual practitioner roles and responsibilities for an actual execution. It lacked sufficient dedicated staff resources to plan for an OLA event. And critically, the OIG found that the FDIC had not documented a readiness plan for executing OLA resolution authorities in a financial crisis scenario involving concurrent failures of multiple systemically important financial companies. Read that again carefully. The specific scenario for which the OLA framework was designed, multiple large institutions failing simultaneously during a systemic crisis, is the exact scenario for which the FDIC's own Inspector General said the agency had no documented readiness plan. The OIG issued 17 specific recommendations to address these gaps. And as of April 2026, rather than expanding its capacity, the FDIC's workforce has declined by approximately 20%, with the agency's own Inspector General expressing concern that the personnel reductions could impact the FDIC's ability to maintain sufficient skilled examiners and execute resolution and receivership activities. That is the framework on paper. Now let me show you what actually happens when it gets tested in real life, because the gap between the legal architecture and the real-world outcomes tells you everything you need to know about what your deposits above $250,000 are actually worth in a genuine crisis. 3 case studies, 3 different scenarios, 3 different outcomes that together reveal exactly how the bail-in framework operates when the stakes are real and the clock is ticking. The first is Cyprus in 2013. Cyprus had built a banking system that grew to 8 times the size of the country's entire GDP by accumulating Greek sovereign debt. When Greece restructured that debt, the losses were catastrophic for Cypriot banks. The 2 largest institutions, Laiki Bank and the Bank of Cyprus, were effectively insolvent. The international lenders coordinated by the European Central Bank refused to provide a full bailout that would have protected all depositors. The initial proposal that leaked to the press would have imposed a levy of 7.5% on all deposits, including insured deposits below $100,000. The political backlash was immediate and intense. The proposal was withdrawn, but the final resolution that replaced it was arguably worse for large depositors. At Laiki Bank, deposits above $100,000 lost everything. The bank was wound down completely. At the Bank of Cyprus, deposits above $100,000 were subjected to a haircut of approximately 47.5%. Depositors woke up one morning and nearly half their money had been converted into equity in a bank that was itself in crisis. Banks were closed for approximately 12 days. Capital controls, limits on how much money citizens could withdraw or transfer, remained in place for nearly 2 years. This is not ancient financial history. This happened in a modern Western democracy with a functioning deposit insurance framework. And it happened not because the legal system broke down, but because the legal system worked exactly as it was designed to work when the losses were real and the insurance fund was inadequate. The second case study is Silicon Valley Bank, March 2023. And this one happened here, in the United States, under the exact legal framework we have been describing. SVB failed on March 10, 2023. At the moment of failure, SVB held approximately $175 billion in deposits. Approximately $151 billion of those deposits, roughly 90%, were uninsured, meaning they were held in accounts above the $250,000 FDIC limit. The initial public statement from the FDIC on the day of failure was straightforward. Insured depositors would be protected and uninsured depositors would receive receivership certificates, meaning they would have a claim against the assets of the failed bank to be paid out as those assets were liquidated over time. That was the Dodd-Frank framework operating exactly as written. The law was being applied correctly. Uninsured depositors were being treated as unsecured creditors, which is precisely what the law says they are. But SVB's depositor base was not anonymous. It was concentrated in the startup and venture capital ecosystem of Silicon Valley. Many of those uninsured depositors were technology companies using SVB to process employee payroll. If the receivership certificate path had proceeded, businesses throughout the technology sector would have been unable to make payroll within days. The economic and political pressure was immediate and enormous. 48 hours after the initial FDIC statement, the Treasury Secretary, the FDIC Board, and the Federal Reserve Board invoked the systemic risk exception, a provision in existing law that allows federal regulators to override the standard resolution framework and guarantee all deposits, insured and uninsured alike, if they collectively determine that allowing losses would cause serious adverse effects on economic conditions or financial stability. All deposits at SVB were guaranteed. All uninsured depositors received full protection. The bail-in framework that the law had established was set aside by a real-time political decision made under extreme time pressure by 3 officials who concluded that the consequences of applying the law as written were too damaging to allow. Here is what that actually means for you as a depositor today. The systemic risk exception is not a standing guarantee. It is not an automatic protection. It is a judgment call made in a 72-hour window by a small group of officials who are simultaneously managing a banking crisis, a potential market contagion, a media storm, and the full weight of political accountability for whatever decision they make. SVB received the systemic risk exception because SVB was large enough, and its depositor base was concentrated enough in a politically and economically visible sector that allowing uninsured depositors to absorb losses was judged to be more dangerous than the precedent of protecting them. The next regional bank to fail with $5 billion in uninsured deposits spread across manufacturing companies and local municipalities in the middle of the country may receive a completely different judgment. The Congressional Research Service documented this directly. The FDIC has never invoked the systemic risk exception for a bank with less than $100 billion in assets. There are hundreds of banks in the United States with assets between $1 billion and $100 billion. Many of the 60 banks currently on the FDIC's problem institution list fall within that range. A failure at any of those institutions does not automatically qualify for systemic risk exception protection. The businesses and organizations holding uninsured deposits at those banks would be subject to the standard resolution framework, the one that treats them as unsecured creditors. The third case study is playing out right now, in 2026, in the private credit market. And while it does not involve FDIC-insured bank deposits, it documents the same dynamic in a parallel system and shows you exactly how gating mechanisms and creditor hierarchies operate when liquidity pressure exceeds capacity. When Blackstone restricted withdrawals on its private credit vehicle to 7% of net asset value in the first quarter of 2026, investors who expected to receive their full requested redemptions on the standard quarterly schedule were told they could only receive a fraction of what they asked for. The same restriction occurred at BlackRock's HPS Corporate Lending Fund, at Morgan Stanley's North Haven Private Income Fund, at Cliffwater, and at Blue Owl. These were not illegal seizures. These were contractual enforcement mechanisms. Withdrawal limit provisions that every investor had agreed to in the fund documents, being activated because the volume of redemption requests exceeded the fund's liquid asset capacity. Multiple financial analysts described the situation publicly as resembling a bank run. The structural dynamic is identical to the bail-in logic. When an institution does not have sufficient liquid assets to meet all claims simultaneously, the losses or delays are distributed among creditors according to a hierarchy. In this case, among investors according to contract, no FDIC protection, no systemic risk exception, no political override available. The liquidity provision was real until it wasn't, and the investors who had assumed quarterly redemption windows would always be available discovered that the assumption was conditional. Now bring all of this back to where we stand on April 28, 2026, because the specific convergence of conditions on this date is why this analysis cannot be delayed. The St. Louis Federal Reserve's April 2026 Banking Analytics release confirmed that uninsured deposits represented 43.3% of all commercial bank deposits at the end of Q4 2025, back toward pre-pandemic levels after declining following the 2023 SVB stress episode. Total uninsured deposits sit at approximately $9 trillion. The FDIC's Q4 2025 quarterly banking profile documented the Deposit Insurance Fund at $153.9 billion, a reserve ratio of 1.42% against insured deposits. The Federal Reserve's own published guidance identifies 2% as the minimum reserve ratio the fund needs to withstand a future crisis. At 142%, the DIF is operating at 30% below its own target stress survival level. The Orderly Liquidation Fund, the Treasury-backed facility specifically designed to provide the FDIC with liquidity for executing an OLA resolution of a systemically important institution, has a balance of zero. The FDIC would have to borrow directly from the U.S. Treasury to fund any large-scale OLA resolution. That is precisely why regulators in 2023 chose to use the Deposit Insurance Fund and the Systemic Risk Exception rather than the OLA Fund, because using the OLF would have made it explicit that the protection of SVB's uninsured depositors was placing taxpayer dollars at risk. There are 3 false beliefs about this system that most Americans are operating under right now, and I want to correct all 3 precisely because the gap between these beliefs and legal reality is where the risk lives. The first false belief is that FDIC insurance means your money in an FDIC-insured bank is protected. It means your money up to $250,000 per depositor per account ownership category at each insured institution is protected. Everything above that threshold is not insured. The average uninsured deposit balance as of mid-2025 was $2 million per account. The businesses, municipalities, payroll accounts, and high net worth individuals holding balances at that level are functioning as unsecured creditors of their banks whether they know it or not. The second false belief is that the systemic risk exception will always be invoked to protect large depositors when banks fail. As we documented, the systemic risk exception has never been applied to an institution with less than $100 billion in assets. The majority of the FDIC's current problem institution list consists of banks that do not approach that threshold. If any of those banks fail, the standard resolution framework applies. The third false belief is that the bail-in framework is a theoretical worst-case scenario that would never actually be used in the United States. Cyprus used it. The United States came within 48 hours of using it at SVB before the systemic risk exception reversed the initial decision. The framework is not theoretical, it is operational, it is documented in federal law, and the conditions that determine whether it gets applied to any given depositor's account are real-time political and economic judgments made under crisis pressure, not standing guarantees written into deposit agreements. So what does this mean for practical decision-making? I want to be precise here because the appropriate response to understanding this framework is not panic, and it is not moving everything to cash under a mattress. It is structured awareness. If you are a business owner maintaining a commercial operating account at a single bank, you need to understand that balances above $250,000 at any single institution carry a legal classification of unsecured creditor exposure. Diversification across multiple institutions, each maintained below the FDIC limit, eliminates that exposure structurally. If you are a municipality or public entity maintaining treasury deposits at a commercial bank, you need to understand that the intragovernmental basis on which you may assume protection does not exist in federal law above the $250,000 limit unless a systemic risk exception is specifically invoked. If you are managing a payroll account, you need to understand that the businesses that faced existential crisis during the 72-hour SVB resolution were businesses that had concentrated their entire payroll operation in a single institution with no backup. The resolution of that crisis required a political intervention that may not be repeated under different circumstances with different institutions. The FDIC problem institution list as of December 31, 2025 contains 60 banks. The total assets of those 60 institutions are no longer disclosed publicly following a policy change by FDIC Chairman Travis Hill. What we know is that 60 institutions are operating under sufficient supervisory concern that the FDIC has placed them on formal watch. What we do not know, because the data is now withheld, is how much in uninsured deposits those 60 institutions collectively hold, or how concentrated the exposure is at specific institutions. That opacity is itself a risk factor. The depositors and businesses maintaining accounts at those 60 institutions cannot assess their own exposure because the regulatory disclosure that would allow that assessment has been removed from the public record. And layered on top of all of this is the macro environment that surrounds April 28, 2026 specifically. The Federal Open Market Committee is in its two-day meeting producing what will be Jerome Powell's last press conference as Federal Reserve Chair before his term ends. The Bank of Japan has delivered its quarterly outlook report signaling a rate hike toward 1% in June, a development with direct implications for the yen carry trade that funds significant positions in U.S. financial markets. Brent crude is trading above $100 per barrel, and the Strait of Hormuz, through which approximately 20% of globally traded oil passes, remains functionally closed. Microsoft, Alphabet, Meta, and Amazon are all reporting earnings in the same narrow window as the FOMC statement. The compression of these events into a single 48-hour period creates the exact conditions under which financial stress can accelerate faster than institutional response mechanisms are designed to handle. This is not a prediction of imminent crisis. It is a documentation of simultaneous pressures converging on a system whose legal architecture already contains known gaps, whose primary insurance reserve is operating 30% below its own stress target, and whose readiness for concurrent institutional failures has been questioned in writing by its own oversight body. The $9 trillion sitting in uninsured American bank deposits is not in imminent danger today. But the depositors and businesses holding that $9 trillion deserve to understand precisely what legal framework governs their exposure, and precisely what real-world conditions determine whether the protections they assume they have will actually be applied when they need them. The bail-in is not a prediction. It is a documented legal architecture. Understanding it is not fear. It is the minimum standard of financial literacy required for anyone operating a business, managing institutional deposits, or making decisions about where significant amounts of money should be held in the United States in April 2026. This has been Recession Warnings. The documents are real. The law is written. The gaps are documented. And the decision about what to do with that information belongs to you.